Hey, everybody. Back here with another SMB podcast. And today we have Mathias Smith from Pioneer Capital Advisory. Pioneer Capital specializes in SBA 7 loan consulting for those that are trying to get SBA loans. It can be a little bit more burdensome than you think up front. Matthias's team has closed over 62 loans since May of 22, representing $100 million in loan value for SMB and ETA entrepreneurs. He'll help you ensure your deal is presented to lenders and best fit for who's involved in the lending process to get you over the line. Thanks, Matthias, for joining today. Great to have you.
Dennis, good to be on. Huge fan of the podcast. Definitely love some of the people you've had on here. My accountant, Chris Barrett, Midwest CPA, as well as your cash flow videos on Twitter, or I guess X is what we're calling it now. But yeah, huge fan of your content, man. Thanks for having me.
Yeah, no, it's great to have you. And for those that don't know, Matthias is very active on X and has a lot of good details on there, as well as a really good newsletter going about the intricacies with the SBA. So definitely, encourage folks to take a look at that as they learn more about the SBA process. So to kick it off, Matthias works with a lot of lenders, top lenders in the nation that work on this SBA stuff specifically. So it's really a specialized field for him. So to start, can you just go over high level kind of what SBA lenders look to see for a business history, profitability, overall structure, and before they're willing to finance it, kind of what the big key metrics are?
Yeah, of course it is. So super high level. So the SBA 7A loan program, not to sound super professorial here, it lends or the loan facilities are insured by the U.S. government, so the SBA. So it's not the SBA lending the money directly. Functionally, they act kind of similar to an insurance company. So generally speaking, they're backing up to 3/4 or 75% of the SBA loan. The maximum amount is $5 million. And so you as a buyer have to come to the table with what's called 10% equity, which just means the same thing as down payment conceptually. And that's proportional to the total loan budget. So the purchase price of the business plus everything else. So if you're buying, let's call it, an $850,000 business, and then you have $150,000 of other stuff. So cash to the balance sheet at closing, bank closing costs, buyer attorney fee, financial due diligence costs. You need to come up with 10% equity proportional to that million. I'm not sure if I answered the question there.
No, that's perfect. I mean, that's just a high level for those looking for structure as well. But then, in terms of once I kind of move past that, right? So I've got my 10% down payment, and including fees, including overall consideration. From there, if I've identified a business and I'm coming to you with your lending partners, what do they look for from the business in perspective of its history or profitability or certain metrics? What are key items that they kind of highlight that would be a stronger deal versus a weaker deal?
Yeah, great question. So the biggest thing is going to be stability of earnings, ideally over at least, the last year as well as the year-to-date period in the trailing 12 months. And the more conservative banks will give the better financing terms, like to look back 2 years. So right now, given that we're recording this podcast in October of 2024, they'd want to see stability of earnings going back 22, 23, the year-to-date period in the trailing 12 months, so going back to October of last year. And then for companies that have had kind of a jump in earnings, if it's contract-based revenue, so think like a property management company where it's business to business or similar, is seeing the longevity of those contracts and being able to kind of forecast forward to see what normalized earnings will look like post-acquisition. And then for you as the buyer, I'm not sure if you asked this kind of specifically within that question, is knowing why you're a good fit for this business and what you specifically brings the deal. So perhaps you're coming from like a products background, working at Amazon or Meta, some people still call it Facebook, and you're going to kind of go in and professionalize, the website and make things just more professional from like a software SaaS standpoint. That could be the X factor that you bring to the business and the business plan. And then that's the question is, how can you convey that to the bank and make it make sense for them what you bring to the deal?
Yeah, that actually jumps ahead to my next question. There's a lot that goes into the underwriting process. We've talked to a few lenders about buyers' backgrounds. So if I'm going into this process, what are the main aspects? We touched on the main aspects of the deal, but how do they separate out how they underwrite me as a buyer, right? What are they looking for in terms of my background or professional history? Understanding all lenders are a little bit different in that bucket.
Yeah, so as far as what the bank is going to be looking for with your background, Dennis, it's going to depend very much on the business that you're buying. And so, let's just say hypothetically you want to buy an HVAC business or something that's very blue collar in nature. There's trade CAD business, HVAC, plumbing, electrical. They really want to understand, are you going to actually relate to that type of workforce when you go in? And not so much just, is the business itself one that's viable from a stability of earnings standpoint? And are you thinking about this company correctly from a growth standpoint? But where do we plug Dennis in this business so that he doesn't break it, if that makes sense? And so what I tell lots of buyers, especially when they're looking at those types of companies, I'll give you a perfect example of one, is a guy that I worked with that bought, it was an auto collision facility in Maryland, is that specific business had a GM in place. So essentially the question is, when you unwind the seller from the business and kind of pull them out, what's being lost as far as what they're doing on a day-to-day standpoint? And specifically any specific industry know-how that you're going to lose, especially when you're doing a complete acquisition and you can only keep the seller in for up to 12 months post acquisition. That's where the bank really wants to drill down and see, what does the human capital employee infrastructure look like within this business from a loss of knowledge transfer standpoint once you pull the seller out, if that helps.
No, yeah, definitely, and also, we've talked about some of the paperwork requirements and stuff as well. I think for this we can focus more on the process because I think what folks are really interested too is there's obviously a business plan component to this SBA process. You have to present a business plan, which you actually have another business with for just business plans called SMB business plans for those interested. So could you go over kind of process based stuff? Let's say I do find my company of my dreams. I contact your firm. What's the overall process timeline and sort of a post LOI business plan SBA submission, just from a high level standpoint?
Yeah, so super high level. So kind of reverse engineering here from the point in time that you have everything needed to actually start the process. So you have the business plan done, the 3-year financial projection, your personal financial statement as the buyer, your last 3 years of personal tax returns, your resume, and then the financials for the business that are being purchased. So essentially, last 3 years of business tax returns, current year-to-date profit and loss statement, balance sheet, and then also the signed letter of intent, broker listing, and some type of a source and use chart. At that point in time, essentially, once the deal is with the bank, so like on the underwriter's desk, generally speaking, it's somewhere on like a 10-week process plus minus with some variance depending on the bank to get to an actual closing. In the way that the cookie actually crumbles from a timeline standpoint, what I found to be the case in about 62 of these dentists is that somewhere around 2 weeks on the fast end with the faster banks to get from start of underwriting to approval. On the longer end with banks that have a longer kind of time frame, maybe they're at capacity, slow time of year. Like right now, we're in the 4th financial quarter where lots of these banks just have a huge queue. It can take somewhere closer to a month. And these timeframes are indicative of people that are being responsive and fast on questions. Lots of these buyers, they might have a day job, so there could be like an 8-hour delay, 10-hour delay in email responses, which can slow things. And then also having a very responsive buy side and sell side attorney. So you really want to be working with a firm that does M&A legal and where this is their bread and butter.
Yeah, that's a big point as well. And from your perspective, we've talked about it quite a bit, but when do you encourage buyers to bring in legal and QV counterparts, and how do you kind of view them in the lending process from your perspective?
Yeah, so specifically on the legal, what I tell buyers is the first LOI that they write, the first deal that they're pursuing is to have an attorney lay eyes on it. So there are lots of LOI templates that are out there. SMB Law Group, for example, has one. Ellie Albrecht with Albrecht Law has one. I think Eric Sue with Clear Focus Law has one too. And so what I tell buyers is, talk with the different attorneys, feel like which law firm you might have a good alignment with, just from a personality standpoint. Do you feel like you'd vibe well with this legal provider through the process? Ask them for their template. Generally speaking, they're willing to provide it. Try to take a swing at filling it out on your own, and then have them give it kind of the final polished scrub before you submit at least the initial LOI. Once you feel like you have things under control and you've done one or two of these and had someone else lay eyes on it, at that point, feel free to do it on your own. To the question on the QB, it's a little bit more tricky there. And so what I tell buyers typically is you want to try to do a working capital analysis before you submit the LOI. And there are some different spreadsheets out there. So Chris Barrett, who you've had on the podcast over at Midwest CPA, he has a phenomenal working capital analysis tool. So if you reach out to Chris, I'm sure if you're listening to the podcast, he'd gladly provide it just purely as a lead generation tool. Shout out to Chris. But as far as actually engaging on the QB, what I tell people is if you've sussed out the working capital, wait until you're actually under LOI, because the QB is not cheap. Now, generally these providers will phase it out. So there's going to be the first phase and then the second phase. And the first phase is kind of major red flags to see, is this a sound business? Is there kind of any hidden landmines or, claymores that are going to pop up and cause issues? But once you get past that first phase, then that's when you start incurring the billing for the second phase. Now, one thing just to mention too here as well on the podcast for different buyers is some of these financial due diligence providers and law firms, and just out of respect for confidentiality, I can't say which ones, will give you the option to basically not pay them, but have them take an equity position in your deal so that you can save on those costs. So if you're a buyer, if you're talking with different attorneys and different financial due diligence providers, one question I recommend asking essentially is, are they willing to essentially do their work more or less for an equity stake for the same dollar value as what their cost would be? And that can help you save on costs on the buy side.
Yeah, that was another question we had here to loop into. If I'm a buyer, obviously, I've gone through maybe a few months of searching. I put up some basic costs as I approach, a live transaction under LOI. I have to make decisions based on legal and QV. Can you just touch on quickly what capabilities there are to roll those costs into the deal? So if I've spent out of pocket, $20 or $30 or $50,000, does the SBA view that as part of my equity injection, or is it considered separate deal costs out of my pocket?
Yeah, absolutely fantastic question, Dennis. So the answer to the question is, when you're getting to the term sheet process with the bank initially before you go into underwriting, and you're kind of constructing and architecting, if that's a word, I may have just made it up, the loan budget. If they have the legal and the financial due diligence costs in the loan budget, if you pay $1 towards any of those buckets, so think about these as buckets of categories in the loan budget ahead of the closing, that can get credited towards your down payment and reduce the remaining amount of cash you have to bring at closing. Very much in the same way that if you're buying real estate and you have earnest money payments, that reduces how much you have left that you have to bring at closing. So that's the analogy I try to draw up for buyers, just to make it make sense conceptually, because this is foreign the first time you're doing this. Is you have the different buckets in the loan budget. So there's the purchase price for the business bucket, there's the closing cost bucket, working capital, cash to the balance sheet bucket, the SBA guarantee fee bucket, and then diligence bucket. And so, if you write a check to, I'm just picking up a law firm here, SMB Law, for $10,000, and let's say your down payment requirement's $100,000 or $250,000, the remaining amount due at closing would be $90,000 or $100,000 less the 10, or same thing with the $250 less the 10. That makes
Yeah.
sense.
No, and it's a key point that a lot of folks have questions on. So I appreciate you clarifying
Yeah.
because I think,
One flag here, just super quick too, before progressing to the next question,
yeah,
is some of the banks that are kind of getting into the trenches on the search fund model are not as familiar with including these legal costs in the financial due diligence costs in the loan budget. And these are also some of the same banks that will give you more compelling interest rates just due to them being a little bit more conservative. And so, what I tell buyers and anyone listening to this podcast is socialize with the bank before you decide to start working with them if they will be comfortable with you counting those payments towards the down payment. Because some of them, it's like still kind of new and they're still getting the lay of the land here, traversing through the space as they get familiar with ETA. And you don't want to kind of leave it up to chance that they're going to be comfortable counting the payment towards that. And some of them may say, you'll just use the working capital you're getting from the loans to reimburse yourself. But if you're a self-funded searcher, especially pursuing a larger deal, every single dollar matters, and it could impact the equity raise amount and similar if they can't count it. So I just want to flag that.
yeah, there's definitely some variability in the market. And especially as Matthias talked about, different lenders always have different criteria. So to his point, try and socialize that stuff up front, establish the relationship and have that conversation because you don't want to be out of pocket, significant amount of money down the road headed into close, in a surprise situation. So, make sure you talk with different banks, and maybe we can switch over to that. Matthias is kind of, can you talk to me how you don't have to name names and the exact process, but just high level how you go about talking to different banks in your network and maybe give people more of a sense of the universe of lenders out there, high level too, and kind of how you focus on the top lenders, et cetera.
Yeah, for sure. So super high level, I kind of group banks into three different buckets. So the most conservative bucket, they want to see 1.5 debt service coverage or higher. They want to see 10% down, all coming from cash, from the person signing the personal guarantees, the operator, buyer, and investors collectively. They don't want to lend, let's call it more than 75% to 80% of the total use of funds. And they're also going to likely rule out any industries that touch construction or adjacent to construction or anything related to project based revenue. So that's kind of the most conservative bucket. The more middle of the road bucket, Dennis, is generally banks that will lend in, let's call it the 1.25 to 1.35 DSCR band, around that area. They'll go up to about an 85% leverage point maximum. And then they're fine with the buyer having a combination of buyer and or investor cash collectively with seller financing on partial standby, so 2 years of no payments followed by an 8-year amortization, or the full standby for part of the down payment. And then the most aggressive camp of banks, and one thing kept bouncing back to camp number two, is those banks won't roll out those new construction or construction adjacent companies, and they're fine with the project based revenue as long as their earnings are pretty stabilized over periods of time. The most aggressive camp of banks will go up to 90% leverage. They're fine if the buyer wants to do the cash combination, partial standby seller financing combination for the down payment. And then they're going to underwrite to like 1.15, 1.2 debt coverage. They'll only look back to the prior year. So in this case, 2023 and the current year to date and TTM period. So that's kind of how I tell people to think about banks from like the broader macro 30,000 foot overview. And then I think I may have deflected part of your question or missed the latter part of it.
No, that's perfect. I think just want to understand better the different relationships, and we get a ton of questions on our daily reviews because we generally put a 10-10-80 structure up there, right? 10%
Yeah,
equity injection, 10% seller note, and 80% SBA, and then offer up a basic overview where we're doing high level reviews. But we get a lot of questions on. They see a lot of influencers that say you can put 0% down. Some say 5%
right.
down. Some say 10.
And,
So
and just to
you know,
jump in there, so here's kind of the analogy. I'm full of these metaphors and analogies, so apologies if these sound dumb
oh,
to
we love
listeners.
analogies. Yeah.
Is think about banks as different like cops on the highway, right? So like there are some cops that will pull you over if you're going a mile over the speed limit, right? Like middle of the road America at a roommate that got pulled over in college for going like 2 over the speed limit in Kansas. But so like there are those types of banks, more conservative ones. There are banks that will pull you over for going 5 over the speed limit. And then there are ones where if you're going the common speed down the highway, they just couldn't care. And so analogously here, back to the, what the SBA allows versus what banks will actually approve. Most banks, when it comes to the down payment, Dennis, they will, they're accommodating of either the 10% cash coming from the buyer or investors, or the more market with the less conservative, middle of the road and more aggressive banks, is they're fine if the buyer and or investors collectively does half of the down payment as cash, but they really want to see at least that amount to show economic skin in the game. And then the other half of the down payment coming from the seller's note on the 2-year standby, followed by the 8 years of the amortization or the full standby. And so intermittently, I've seen deals with the no down payment, but no down payment meaning the seller's note functioning as the total 10% down if it's on the 2-year standby, followed by the 8-year amortization or the full standby. But when I've seen that done, it's been 2 specific scenarios, or kind of 2 different groups of deals. One is the management buyout deal. So say that you hypothetically, Dennis, or let's say I'm working for you, you run an engineering firm, I'm the head engineer, I've been there for 8 years, 10 years, and you're looking to sell. I've scraped together 401k funds. Let's say my liquidity position, $75,000. You're looking for a $2 million bid on the business or something like that. And I just don't have the cash to come up with the down payment, but I also don't want to do an equity raise because I want to have majority control. I don't want to have to answer to investors. And in that circumstance, I've seen banks fine with the 2-year seller, the partial standby seller's note, 2 years of no payments followed by the 8-year amortization or the full standby, counting towards the full down payment, with the rationale being that they look at my experience working for you, Dennis, as skin in the game, if that makes sense. And I have the experience in the industry and working the business, so there's less transaction risk and less deal risk than an external buyer being introduced to the company where they're putting no money in. And the other thing too, honestly, is, a lot of the people, they'll read buy them build, they'll see some of the flashy videos on Instagram from different influencers. I won't name specific names, I'll just leave it up to imagination. And they want to have, a minimum bar to kind of being able to do business. And they don't want any Joe or Jane off the street just doing a deal and floundering and then having the kind of whole house of cards burn, if that makes sense.
Yeah, no, it definitely does. And that was extremely helpful in terms of going over all that. I think also, could we just hit on the differences in those seller note metrics from a 10% standpoint? So let's say on your breakdown, the most conservative would be a 10% equity cash payment by a buyer, right? If I can then go to the seller and get a partial or full standby note, one, what's the difference for those out there? And then two, how much of the 10% is, I'll give the answer with 5%, but how much of the 10% can I give away to those notes if I structure it a certain way?
What was the first part of the question again?
So just kind of breaking down if the comparing a traditional sort of 10% down equity payment versus a combination of some sort of partial or standby seller's note, because obviously that's been a moving target in the market the last year or so. But if I were to have to go and get a partial or full seller standby note, I'm allowed to use that as part of my equity injection as a buyer.
Yeah. So the question is, so I make sure I'm tracking so I can answer correct. It's
I guess just like an overview of the different notes. Yeah.
Oh yeah. So okay. So I'm tracking with you here. So there are 2 different kind of buckets of seller's notes. There's kind of bucket 1 of types of seller notes you're using towards a down payment. And those are ones where either it has to be on the old kind of classic full standby, where, it could only accrue interest while the SBA loan's outstanding. The interest would be building up on the principal balance. And then after the SBA loan, was paid off, at that point in time, you could pay it off and refinance it or cash on the balance sheet. Then there's the partial standby seller's note, where you have the no payments for the first 2 years after closing, and then you have payments made year 3 through year 10, where the built up interest that's accrued on the seller's note over the first 2 years is amortized with the initial principal. Amortized just being stretched out for anyone not familiar with that nomenclature. So that's kind of the first kind of grouping or subset of these seller notes. The second grouping is ones that aren't being used towards the down payment. And one clear distinction I want to make with that first grouping, the seller notes that are being used towards the down payment, is you can't have any type of a balloon on the full standby or the partial standby. So sometimes what I see is people will come to me, they'll have this signed letter of intent. They didn't know this at the point in time they went under LOI, so it's not anyone's fault, is they will essentially decide that they're going to have the balloon on the seller's note. And fortunately, that makes it so you can't use it towards the down payment. So just one distinction to draw there. The second camp of seller's notes are ones where you're using them towards the down payment. And essentially that specific type of seller's note, camp number 2 is ones that aren't being used towards the down payment. Those do not need to have any sort of a standby period. Those you can make payments at the gate, so starting the month after closing if you so decide to. And generally speaking, what I tell business buyers, Dennis, is try to get the amortization for the non-down payment seller's note to be 10 years to match that amortization period of the SBA loan, but have a balloon kicker if you want sooner. So park a balloon at year 4, year 5, or similar. And the specific reason why is the bank conceptually does not like to see the amortization of the seller's note being faster than the amortization of the SBA loan. And it's kind of 2 different reasons. One is obvious, which is debt service coverage, is if you have a shorter amortization, your payments are going to be higher. But the second is just philosophical and optics. And if you think about it, the person looking, voting on the loan on loan committee, they're going to kind of ask the question, if we as a bank are extending 85 to, or let's call it 70 to 90% financing, generally not 90%, but 75 to 90% financing to this buyer, and if our loan's amortizing over 10 years, why should the seller that's extending anywhere between like a 5% seller's note to upwards of 15 or more, why should they be getting paid back 2 times as fast on their financing as we are, or what have you, right? And so it's very much an optics thing. And so generally what I tell most buyers is by the time you're at year 4, year 5, if you've been performing well on the business and if things are going well, generally speaking, the bank that you took out the financing with will be open to entertaining refinancing of that seller's note at that point in time. And the SBA's guidelines states that the seller's note, if it's used to buy the business before it can be refinanced with the SBA, it has to be outstanding for 2 years. And so that's why you want to wait at least until at the very minimum year 3 to park the balloon. And that's for the non-down payment seller's note. And then one last thing just to mention, because I know I've kind of rambled here, is you want to make sure
exactly what they want. So perfect.
You want to make sure in any circumstance when you're drafting up an LOI that you allude to the SBA standby creditor agreement for any type of seller note you're using. And so if you go on Google, if you type in SBA Form 155 or SBA standby creditor agreement, you'll find kind of a boilerplate version of this document. Because one thing I've seen before is on the buyers that don't mention this and or they wait until the last possible moment, is you get an attorney on the sell side that basically says, whoa, like you're junior to the SBA bank. Well, of course you're as a seller, right? You're subordinate, but the communication was lackluster and just not good. And so that can really create friction and throw up obstacles towards the end of the process. So just make sure to flag that in the LOI.
No, that's a big point too. Just a lack of communication there down the line can lead to a big headache. Absolutely.
Yeah.
And then I think we have like 10 more minutes, so I was just going to go over a couple deals that you've done if you have the time, and then we could
Yeah, of
call it a
course.
pot. All right, one second. Let me make sure
Cool.
I can do this technology. Here we go. But yeah, no, it's definitely, I'm sure people have questions for you. We'll have to have you on again too because you're just so knowledgeable about this space. But here is Matthias's website for those interested, Pioneer Capital Advisory. And we're going to pick up this first one was a commercial HVAC firm. So Pioneer utilized its relationships here with top SBA lenders to secure a $1.1 million SBA loan for the buyers, which included $85,000 of working capital. The loan financed 90% of the total project costs. The buyers were able to utilize a seller note on a full standby for half of their required 10% down payment, kind of what we were just talking about. And the loan was placed with a top 5 nationwide SBA lender. So I'll kick it over to Matthias to kind of give us a quick high-level overview.
Yeah, so this was a husband-wife couple that was moving from California to the Mountain West to buy this business. There was a general manager in place that was I honestly have to go back and look through my notes here. It was either the qualifier of the HVAC license, but essentially the GM very much kind of wove the industry experience into the deal.
Okay.
And so the wife came from a sales kind of executive type background, the husband from a marketing background. And so basically they were partnering with a financial sponsor that was doing most of the down payment. And so they were kind of bringing in this experienced dentist, albeit nothing related specifically to the HVAC, to professionalize this company. And the crazy thing, and this doesn't have anything to do with the deal, and I have to go back and look through my text here, is the people that bought this business have gone on since to do bolt-on acquisitions. And so this specific deal closed in September of 2022. This deal is very near and dear to my heart because it was actually the first deal I ever closed at Pioneer.
Okay.
And so basically I went 4 months without making any money, going from $88,000 a year to closing this deal. I think the commission was like $10,200 or something like that. So it was the first time I was able to tell my wife that I was going to be able to put bread on the table after leaving my job. But I want to
A big
find this
moment for all
exact.
entrepreneurs. Absolutely.
It was a huge moment. I only have this in my text, but these guys have gone on to do these add-ons, Dennis, since buying this, and they're crushing it. It's insane. So I'm super happy for them.
Good for them, and also awesome to hear that that is one that was your first one. I know that's probably the hardest, and it's never easy to start your own business. Nevertheless, get that first win. So
Yeah.
a great win there. I think we'll move over here to this towing company. Let's see if it worked. So this is another deal that Matthias and his team put together. They announced the closing of a $4.1 million acquisition for a towing company, which generally can be very challenging companies to close. So I'm sure there's some background here. But here, Pioneer was able to get, within 3 days of engagement, 3 term sheets for the entrepreneur, 2 of which were with top 5 SBA lenders. And for funding, the debt structure included bank financing of almost 3.7 million. They financed a little over 83% of the deal. There's also an SBA Express line of credit for $350,000 at closed, with a interest rate of prime plus 2.1 fixed for 5 years. So another interesting one here, towing can be tough. So what about your deal here with the towing company?
Yeah, so I guess a couple different things here to dive in on this deal that I think may be of more interest than towing cap to the broader audience. So one is on the SB Express line of credit. So there are kind of 3 ways that you can get working capital into a deal as a buyer. One is negotiating it into the purchase price of the business. So basically setting a peg in the LOI that you're going to have a normalized level of working capital at the time that you close the business. And there have been kind of interesting schools of thought in this. For anyone watching this podcast, if you go on Twitter, look up Clint Fiore. He's a really good sell-side business broker in the San Antonio, Texas market. And basically, there's kind of this give and take when it comes to working capital. when you go under LOI until you enter financial due diligence, and I know, Dennis, you kind of asked about the QV towards the start of the podcast,
Yep.
it's how do you know how much working capital you're going to need as a buyer? So you sometimes leave the loose language in there saying it will be decided at the QV, but then as a seller, you don't want to accept a bid or an offer where it's an unknown, because then you don't know how much cash you're getting at closing. So the three different ways you can get the working capital into the business or into the acquisition is one, including the purchase price. The second way is having the bank finance some permanent working capital into the SBA 7A loan. Generally speaking, most banks will finance in what's deemed as like an appropriate level up to the amount of the down payment, but they won't do more, because otherwise, optically to the SBA, if the bank's file was to get audited, it essentially looks like you're just getting the working capital or the down payment kicked back to you as the buyer, if that makes sense conceptually. And
Yeah.
then the third way of getting to this revolving line of credit, and then we'll get back to towing, is you can get a revolver from the bank, and that's most of these banks will provide these, not all, but many. And it's a revolving line where for the first 3 years or 5 years after closing you can draw on it, and then you take 10 years and you subtract either the 3 years or the 5 years, depending on what the bank sets the revolving period at, and then whatever the built up principal balance is plus the interest then amortizes over that period of time. So back to this deal, without getting too tactical in its towing, because I'm not the expert there by any means. What was
No, no,
interesting
it's a
about this
tough one.
deal is this guy bought this business where essentially it was in his backyard. He's in my Google reviews and on the Acquiring Minds podcast. The buyer's name is Matthias Smith. So the Acquiring Minds episode, it talks about buying a business with a general manager. Really, really good to watch. Essentially, he kept or was able to thread the needle, keeping his day job, because he was able to find an operating partner to run this business. And it was turnkey and transitional enough and not super reliant on the seller, where he could pitch the bank the business plan that he was not needed to be the boots on the ground guy running this thing. Now, another flag too that I want to mention here as well is the mention of the guy's house not being in the collateral pool. One thing to be mindful of if you're a business buyer is if you own real estate and if you have equity in the real estate that's 25% or more based on market value, which the bank will ultimately determine with a third party business or appraisal on the real estate, is the real estate needs to be pledged. The SBA mandates that it's pledged on the loan. Now, if you're below that 25% threshold, then it's the bank's discretion. Do they take the lien on the real estate or do they not? So in this case, when I did the outreach to the different banks, two of them came back saying no lien. One of them came back saying they would take the lien. And obviously, just from a pragmatic, smart business standpoint, the guy chose to go with a bank that would not take the lien. And so what I tell buyers is it makes sense very much if you're working right now, if you have a full-time job before you quit your W-2, to go get a line of credit, HELOC, on your house that you have undrawn on as high as you can, really, because it can help shield your house from the SBA loan or from the SBA lender taking a lien on it. And so the bank can still choose if they want to require the lien. They can still say, based on the fact you have $1 million house and a $600,000 mortgage, albeit you have the home equity line as $0 balance, we feel compelled to take the lien on your house. Now, what I tell people is the banks that Pioneer Capital Advisory works with, generally speaking, they do not choose to take the lien if they don't have to, because it, one, increases the time frame to close, and two, it makes it more painful if the bank, if your deal goes sideways if you default, because they have to try to chase after the equity in your house before the SBA will pay them back on the guarantee. So if you're watching this podcast and if you have a good deal and if the bank that you're talking with is going to require a lien in your house, feel free to reach out to me. I'd love to work with you. So
Yeah, no, thank you very much. That's also another point a lot of folks ask us questions on. So I'm glad we got to touch on that. And I think to wrap up, Matthias, just any way that folks can reach out to you, or what specifically you're targeting in market. Love to let people know what you're looking for on your side before we wrap up.
Yeah, so email's the best way to contact me. My first name, Matthias, Matthias at pioneercaps.com. And basically, kind of what we're targeting over here is business buyers that are approaching LOI or kind of close to LOI. Approaching very much meaning what it sounds like. They have a deal where they feel like they're kind of at valuation with the seller, and they, kind of negotiate or done some pre-negotiation on feeling like they're in close proximity, but not quite there. But they're looking for a financing proposal from a bank that they can submit with the LOI to basically show confidence in the sell side that if they get their LOI accepted, they're likely going to be able to get funded. So the deals that we focus on over here are ones where the buyer is looking for at least $1 million from the SBA 7A lender, and then up to the $5 million. There are some banks that we work with that will lend additional conventional financing over and on top of the 5 million, but it limits the pond. On the sub-$1 million deals, just due to kind of manpower and bandwidth constraints, and it has nothing to do at all with me being anti-small deal for anyone watching this video. Those deals will help the buyer get to the term sheet or to the financing proposal, but then after that point in time, it's kind of on them to carry the baton forward to get from the start of underwriting through to closing with the bank.
Awesome. No, I appreciate you giving everyone a breakdown of where you guys are focused, and also look out for Matthias's SMB business plans if you need help there. They have a great service as well. And thanks so much for joining us. I'm sure we'll have you again on in the future.
Yeah, thanks for having me, man. It was good to be on. Cheers.
Talk to you
Bye.
soon.